One. Hello, everyone. Welcome back to this exciting edition of the Exponential Blueprint, which is called the Exponential Exit. It's all about private markets and public ambition, and this is part four. Now, in the previous parts, we've spoken about how big this opportunity is. Effectively, we are speaking to all private companies, which is basically all companies in the world, less the companies that are public, um, they would like to have access to the capital market. So we've spoken in the last few parts. First part about the Supper Club, Sophie 1845. Then we touched on Asset Match, which is really the private market specialist that we are working with together with this. And then in part three, we've spoken about employee share scheme. Now, I have a pleasure of being joined by James Hunt again today. How are you, James, today?
I'm very good. Thank you, Matteo.
Okay, thank you, James. Thank you for participating, for giving us such an opportunity to speak about this subject. A recap about the Exponential Blueprint. It's a newsletter that started in January 2025. Our goal is not to give you information. Our goal is to give you transformation. And this is effectively what we want to do. We want to give you the opportunity to run a business with a high valuation strategies through smart finance, through intellectual property monetization. We want to give you the tools to think like a big company. Now, private markets are a $14 trillion opportunity. How big it is, in terms of the market. And so basically, the key message we would like to give you is that you're not too small, you're just not positioned yet. So we want to give you an opportunity to position. And tax planning is part of this. So let's dive deep into tax and why tax planning is important. The tax challenges, the tax changes that happen all the time with different governments. Tax planning is part of wealth creation. That's absolutely fundamental. But there's something absolutely shocking about tax, which is where I would like James to tell us more about it.
Right. So the shocking truth to my mind is the change that came in or was announced last October that takes effect in April 2026. So this was Rachel Reeves' first budget. And there was a lot of talk about the problems farmers were facing, being asset rich and income poor. But what was much less talked about was the shocking change to inheritance tax that affects owners of the most successful private companies. And I remember James Dyson, Sir James Dyson, I beg his pardon, wrote an excoriating article for the Daily Telegraph. So incensed was he about the wrecking ball that this change was going to make. So in the good old days, up until April 2026, shares in private companies attract 100% business property relief. So that means there is no tax to pay if those shares are passed down to the next generation. From next April, the tax charge is going to be just 20%, half the normal rate. What's your problem? The
Hmm.
salesman in the Labour Party will say, and the debate has taken place on the backdrop of farms, and they were told, well, there's a husband who's got a million, there's a wife who's got a million, and then you've got a house as well, and there are separate reliefs for that. So you can pass a lot of value down. Um, and I think there are significant questions and challenges to be made of that relating to farmers. But we're not here to talk about farmers. We're here to talk about the world of private finance and commerce. Now, Matteo, in the last video, I was doing the old Cerdix Limited. Now, my father used to sell vacuum cleaners. So whenever there's a story about vacuum cleaners, I'm interested. So there are two examples, if you'll bear with me, that I'd like to share on the problems that this new change could create. So we start, if we may, with Sir James Dyson and Dyson Holdings. So you're familiar with Sir James, are you, Matteo?
Yeah, absolutely. Absolutely. One of the most successful entrepreneurs. Yeah.
Yes. So he started his enterprise with the Cyclone vacuum cleaner and then hand dryers and all sorts of other electronic gadgets. Now, I looked up the other day to see that on the Dyson website, they published the fact that their most recent published results showed 1.4 billion of EBITDA. Now, according to Forbes magazine, James Dyson still owns 100% of the company and he's aged 77. So they were saying his personal wealth from that company was probably 14 billion pounds. Now, he's got an offshore structure now. When he relocated his manufacturing to Singapore, he put in place an overseas holding company. And it might be that he's got some clever trusts and other tax planning measures. I doubt it, though, having read the article in the Telegraph. And you can imagine the challenges of a successful man like Dyson. He's got 3 children, one son, I believe, working in the business. He's got 6 grandchildren. So when you're doing your estate planning, you have to think about your family. You have to think about your business. And he's growing a dramatically growing business. So lots of different considerations and very easy and may well be right to put off decisions, fundamental decisions on what you're going to do with the shares in your company, your wealth. So just because someone's 77 and might own all of the shares in this fabulously successful company doesn't mean there's any criticism to be leveled at it. It just means it's a very difficult problem he's wrestling with. So if Sir James should meet an untimely death after April 2026, his estate has only got to pay 2.8 billion pounds in inheritance tax. Now, where's that going to come from? So the natural way that people inheriting shares would pay is out of dividends, the cash flow of the business. So if you decided to do that, you've got to gross it up at, is it 39.35% now, the top rate of dividend tax, Matteo?
Yeah, I mean, that's the case studies you're showing here tells us how big the
Yeah.
problem is,
So 2.8
Yeah.
million grossed up,
Billion, yeah.
2.8 billion grossed up, according to the Hunt arithmetic, comes to 4.2 billion. 4.2 billion pounds. So a tax bill of 4.2 billion pounds. You can see why he was spitting feathers when he wrote to the Daily Telegraph after this wrecking ball tax change.
So
Charge
this
Kenny?
is the question, that many people will ask. Is this actually on the valuation and who decides what the valuation is?
That's a very good question. So that would be down to negotiation with HMRC after the event. And no doubt all sorts of clever reasons could be put forward as to why 14 billion was a ludicrously high valuation. But equally, there might be all sorts of counter arguments that actually it's quite conservative for
Yeah, I
such a
mean,
dynamic business. So it's very uncertain, and that's the problem. The other thing I found interesting with the farmers, there were people saying, well, you can just get insurance. Well,
hmm.
obviously, getting insurance for these sums is very difficult. And yeah, and I don't think insurers necessarily give you the insurance cover automatically. They want to themselves assess whether it's the appropriate sum being insured. So and so the problem with death, of course, is it's uncertain. Or you could have someone who's got severe health problems already, so they won't be able to insure. So you're creating a very significant additional challenge for the most successful entrepreneurs, those who've got a first generation business that's been highly successful. Let me give you another example from the world of vacuum cleaners. So, my wife, when we were at our last home, bought a G-Tech, with the one with the long stem, a G-Tech vacuum. Now, that is the creation of a gentleman called Nick Price, and his business is Grey Technology Limited. And I did a quick check with him before this podcast. So he recently got divorced from his wife. She had 10% of the company. She sold that back to the company, her 10% interest, for £5.75 million. So we may suppose that company is worth at least £50 million. Its last published accounts showed £28 million in the bank. Now, that might affect whether business property relief is available, because that is only available for trading companies and trading assets. And if you've got a significant pile of cash or other investments, it might be taken away as to whole or part. But let's assume that that's not the case, that he can justify the 28 millions in the bank for working capital, and he's got these projects for innovation that's going to consume that cash. So Nick Price, he's a younger man. He's only 57, but we see young people with health problems all the time, don't we? And I couldn't tell from my research whether he has got a leadership and a management team in place beneath him. It looks not. He is a sole director. Never a good idea, I think, to be a sole director in a big enterprise. But anyway, let's assume that we're just looking at a company that is worth 50 million, that is owned by one person 100%, and that company is worth 50 million pounds. So we're talking about 10 million pounds of tax to be paid. So again, if you gross that up, because you think the beneficiaries are going to be paying it out of future dividends, it's over 16.2 million pounds of tax. Now, if we're really serious about creating an enterprise economy, which is what the politicians are always telling us, it's a rather strange way to go about it. Here are the most successful entrepreneurs being clobbered with a tax bill. And historically, it's always been the view that we want to preserve these successful private companies, so we allow it to go generation to generation. And we were talking in the last podcast about the Mittelstand in Germany. Third, fourth, fifth, sixth generation family companies that are highly successful engineers. They are teaching their sons, daughters to be the next generation of leaders. So if we want sustainable and growing companies, it's not a great idea, I would suggest, to tax so badly. So then you put yourself in the shoes of Sir James Dyson or Nick Price. What do they do? What do they think about doing? So the natural inclination may be, God Almighty, I don't want to leave my family with a significant problem. So what I must do now is think about exiting before I die, because I don't want to leave this problem to my family, which is actually the right place to start. Because if you've got a complex growing business, the last thing you want to do is to leave your family to be grieving your death and working out how to manage your company. I'll come on to tell you another dramatic story from my past in a moment on that very front. But let's just think about Dyson and Price. What do they do? So they think, right, I'm going to sell. Now, there might well be a trade buyer who would say, yeah, I'm interested in buying, or there might be a private equity operation that will bring in key management and take it over. But for people of the disposition of Dyson and Price, what I would call the technician entrepreneurs, they're not just into selling and making money. They clearly are highly talented engineers. Very dispiriting thought to think I'm going to sell my company, because it'll then change. Almost impossible for someone with that mindset to become an employee. So they sell, and then they think, right, I'm going to now have a really miserable retirement. So that's not motivational. So what do? They put it off until a crisis happens, ill health or death, And then their family will be faced with this enormous challenge unless they've been wise enough and fortunate enough to find a solution to their challenges.
That's definitely an area that requires so much coverage, I would say.
Yeah, quite. Well, this is
Spending,
what I was grappling with for the
yeah.
12 years I was running my legal practice, Everyman Legal. And through that, I'll tell you this story. We employed a cold caller.
Hmm.
He was a very nice Mancunian, and he got me to meet a manufacturing entrepreneur down in West London. And I went to see this guy, Peter. And over a period of time, I formed a relationship with him and a friendship with him. And I, I gave to him this boss methodology. And he was just, as I met him, about to recruit a key new person who he thought would lead the team. Now, at that stage, Peter was in his mid 60s, late 60s. And he was telling me, this is my last chance, James, to get it right. So I had a previous attempt at recruiting an MD, it didn't work out. So I'm now really focusing on this, doing the psychometric test, getting my friends to interview this guy. Anyway, the guy was just about to start, so I helped him design a share scheme. And I talked earlier about the boss methodology, and one of the favored exit methods then was a vendor-funded management buyout. Could be led by this new guy who was joining. He doesn't have to have the money himself. He can buy the company out of the future cash flow of the business. And Peter could have remained as a significant minority shareholder. Everyone's a winner. Sadly, that didn't work out. About 12, 18 months after this guy joined, when we just finished designing the share incentive and had presented it to the team, including this guy who was going to lead the team, Peter and that gentleman parted ways. And I remember clearly Peter calling me, and the relief in his voice was palpable. The pressure was off. He didn't now have to. There must have been some real tension between him and this intended successor. So he departed. And I was very sad for him, even though he sounded absolutely elated. I'm back in charge.
Hmm.
Anyway, I looked him up the other day and I was delighted to see he'd still got the same team of 50 people, but he posted profits of 1.2 million, which was a good four times what I'd seen when I'd last been with him. So he's got a business, 50 employees, making 1.2 million profit. I remember he was on a site, a huge development potential in West London. So there could be value there of 10 million for the company, perhaps 5 or 10 million for the land. So it could be 15 or 20 million of value. So I took Peter to see a very good tax practitioner in Oxfordshire who I know. He came with his wife, his third wife, and we talked about the future. And the lady was very concerned because she said, what I don't want is when he dies, and if I'm the survivor, my job is to destroy his legacy. Now, that was really profound for me. So here's this lovely guy. He was a musician and he'd had a band that used to play as a warm-up act to the Beatles. I got a really good relationship with Peter. And he obviously loved his business. And I thought, this would be so sad, wouldn't it, for his wife, his partner, to face this prospect. She's grieving for Peter at the same time as having to sell his really complicated business. So tragedy. So death and taxes, the two certainties. So what do we do? Now, this is where I think asset match. Oh, yeah, let's just go back into your next question.
Yeah, I mean, I was going to say, I was going to
How should you lead
already.
the discussion with your tax expert? So,
Yeah, it's about leading the discussion, that's
yeah,
our recommendation. Now, obviously, as you are all aware, by now I'm a CFO. I've been in finance for the last 30 years. So, and for me, tax planning is part of wealth creation. So, yeah, it's about really leading the discussion. And this is where, obviously, I'd like to hear your views, James, about how can a founder not be passive and be actively involved with the tax aspect without obviously giving any indication of any sort of tax position or tax advice at all. But
yeah.
how should this be organized? Yeah.
Right. So the great problem with going to a tax expert is that you're going to see someone who's an expert in tax. That might sound silly, but that is the
Yeah.
problem. So everything will be seen through the lens of tax. Now, I remember shortly after the Reeves budget in October 2025, I saw a number of very capable tax advisors promoting schemes, the purpose of which was for founder entrepreneurs to shift value into different classes of share so they could keep control over the voting shares. And in many respects, that's very sensible and practical, and I wouldn't criticize it. But the trouble is, if you approach something with that mindset, which is right, the problem is we're going to have to pay this amount of tax. So what we're going to do is restructure the share capital. We're then going to give away the non-voting shares to the family. We're going to survive 7 years so we don't have to pay the inheritance tax. You've solved the inheritance tax problem, probably. But have you solved the real problem? Now, the real problem is the one I articulated earlier, the terrible tragedy of Peter. If his wife has to end up destroying his legacy, that's the real problem. So how do we address that real problem? So that requires understanding the psychology of that business owner. And how can we help him and his team see the future? Now, when you and I first met, Matthew, we were having supper, and you came up with what I thought was a lovely perspective on how entrepreneurs ought to plan. So have a 10-year plan, and you're going to exit at year 5.
Yeah.
So you're then saying to potential investors, right, look, here was the plan we had 5 years ago. Here's where we are now. And you've got all of this growth to come, because that's what an investor wants if they're sensible. They're buying the future cash flow. But that then requires that transformational, that exponential mindset, doesn't it? You've got to think, right, we're capable of doing this. And if you've been at the coal face, as someone like Peter will have been for 45, 50 years, he's now late 70s. How can you gain that energy? So part of it, I think, is storytelling. We have to tell ourselves stories that inspire us to begin with. And your advisors, if they're the right people, can help you do that. And they can help you then bring a team together. But then you've still got to ask yourself the question, what's the exit? Because if the great goal is to be miserable in your retirement after you've sold the company, that ain't going to work. So it has to be motivational. And here's where Asset Match is the most wonderful opportunity. Because what you're envisaging is not the end, but the start of a new beginning where you've brought in minority shareholders who are not going to be like the private equity guys wanting all sorts of vetoes and controls and strangling your entrepreneurial flair, as you might see it. I mean, they might actually be telling you lots of things to do that you should be doing, but that's a different story. It's a question of whether it's going to be motivational for the founder, which 9 times out of 10, it's not for the people with that real entrepreneurial mindset. So you've got the opportunity to use Asset Match as a tool to do that 10-year plan that you were talking about, and to then sell it to yourself, your family, your key employees. You've then got to think, how are we going to prepare for admission of our shares to trading on Asset Match? Because it's not something you should do lightly or quickly. It's got to be really well planned. You've got to have that growth plan. And then it sits within it as the powerful communication tool. And what you are doing is putting up a discrete for sale sign. And then funding the tax will be much easier because you're paying tax and only paying 14% or 28% capital gains tax on the sale of those shares. And you can then put that money into something else, which is then more easily realizable, perhaps, than the shares in your company on your death. So it's all a question about having that big, confident vision and having advisors who can support you on that journey to achieve that vision.
Yeah, there are so many considerations to be done here. One of them is about starting the business with an exit plan. And as you were saying
Yeah.
before, it's about not just planning your exit, but the exit of those who are going to buy the business from you after you
Yeah,
exit. Because again, you need to always think that there is growth beyond you, behind and
yeah,
beyond, obviously. The
yeah,
other important consideration to be made is really let's as usual let's observe what the most successful people in the world have done.
yeah,
They have never been in a position where they were obsessed about controlling their business. For example, Bill Gates ended up controlling
yeah,
8% of Microsoft, but effectively, regardless of the number of shares, he was controlling the business. So shares were not necessarily the only way that he was actually the percentage share was not the only way that he was actually
yeah,
gaining advantage from the business. There are so many different ways to
yeah,
effectively organize your future.
yeah,
Now, this podcast will need to last many hours for us to tell you the many
yeah.
ways. But yeah, again, James, we are touching really on the problem right now, but there is so much more to
Yes, I
discuss.
just pick up 2 points there. First of all, I think it's a question of confidence, isn't it?
Mm.
If you are self-confident in the business and the way it's going, you won't mind becoming a minority shareholder. On the other hand, if you're fearful, you'll think, right, I might get sacked. And actually, if you read the Steve Jobs Apple story, you realize how it can go terribly wrong. Because, of course, he got sacked as a young man. I think he was 29 when he was sacked by the person he'd recruited to be his successor or to work with him as his chair. And he does say that it was the making of him. He was out in the wilderness for, what, 5 or 6 years before he came back to Apple when it was literally on the brink of collapse and transformed it. And he said that had he not gone through that trauma of being sacked and finding himself again, by trying to start other businesses, he wouldn't have had that growth mindset that enabled him to come in and then take a company that was, as you were saying the other day, on the brink of bankruptcy and turn it into the most colossal money-making machine.
Yeah, this
So,
is where it pays to look at really what successful people do, really. How do big businesses become bigger as well? Yeah.
yes, that is. And I've spent, I don't know, 40 years trying to work that one out. And not for this one on tax and challenges, but perhaps on another podcast we'll talk about the team dynamic and what's really important to the successful foundation of a business. Because I've learned a lot from personal experience and from reading about Apple and Microsoft, because there are patterns of personality style, leadership style that one sees. But yeah, so mindset is really important. And then the other thing is to have a flexible um, financial environment that allows you, if you are so minded, to keep control. So this is the difference between the UK markets, the London Stock Exchange, and the American markets, where in America they're much more accepting of different class structures. So I think with Google now, I think the founders still have a very, very significant interest. It might be 40, 50% in the voting shares. They might be very small in the non-voting shares. And the London Stock Exchange recently lost a company, was it Wise, because they wanted to maintain beyond 5 years, which the stock exchange now allows, this two-class system. So, and this will be another advantage of Asset Match because they are going to be much more flexible. They're there to help you, not to tell you this is the way to do it. Now, I do start from the viewpoint myself that a single class of shares is best. The simpler you keep things, the better. But sometimes that's not appropriate, and the guys running the business might have different ideas, and you then need to be flexible. But yes, tax changes and challenges. The starting point is how do you grow a really successful business? Then it's lovely to have a tax problem.
And
Dyson might not see it that way at the moment,
you
but
want there are two words that I always use to founders about how to increase the valuation of the business. Word number one, positioning. Word number two, structure. Now, those two words, they carry the valuation to a much higher place. And
Yeah.
this is where, yeah, we need to have conversation about these things because unfortunately we see that these words are not treated in the with the right level of importance they should be.
Yeah.
So the structure can actually, let's say, if you structure the business and you control everything, the value could be 10, 20, 50 times less than if you
Yeah.
structure it in the right way. Now,
Yeah.
guess what? You end up with a 5% shares of a company with the right structure that is worth more than the
Yeah.
100% shares of a company without the right structure. So what's the gain to be made by having 100% of something that doesn't have equal value to a 5% in a company with the right structure? So,
No, and then the other fatal consequence of owning 100% is that you and your family own 100% of the problems.
of the liabilities as well.
The liability. But yeah, so if you've got a highly complex business and you haven't built an A team around you who are great leaders and managers, you're going to find that when you start to have poor health or you die and your family are trying to sort it out, you're leaving them with a very significant problem. So almost by definition, having the confidence to see yourself as a minority shareholder will mean you have the confidence and the ambition, not just for yourself, but for your team. And seeing them all become co-owners is what motivates you. And then so the fact that you haven't got a controlling interest is irrelevant because what you've done is to create this amazing entrepreneurial culture. And you want to be challenged. And you don't want to be the dictator that says this is the way we have to do it. You want to have that collegiate decision making.
Again, this is where, as a final consideration, we can effectively reaffirm the importance of exit plan, preparation, and then eventually also negotiation and execution. Now, exit doesn't mean full exit. It can be a partial exit.
Yeah.
You can still have, interest in the business, and normally, this is where when we study the real successful example in our lifetime, we find that that's the best way forward. Yeah, and this is what Asset Match is looking to achieve. James, please, tell us your view on how Asset Match is going to be able to help entrepreneurs with this.
Well, it's only going to be able to help entrepreneurs if we all up our game.
Hmm.
We,
So
the
yeah,
entrepreneurial advisors, have a really important, a sacred duty here. Because what Asset Match has created is wonderful, but unless there are people who really understand how it can be used, then it will not be the basis for transformational change. So the onus is on us to understand the challenges that these entrepreneurs face in this rapidly changing now environment. So we have to really up our game. We have to be courageous in learning and the advice we give, so that we help those entrepreneurs and we educate ourselves and them on Asset Match. And time is short.
yeah,
AI is
one
going
thing.
to transform the world. And
Mm.
if we're not careful, it will transform it in a negative way. And that will be down to our lack of imagination and ambition.
Yeah, one thing is sure, we're not here to just give you information because you can find information everywhere. We're here to give you transformation as usual. This is our goal. And we're going to give you a transformation also in the last part of the exponential exit, which is going to be part 5, in which we're going to talk about how the exponential blueprint, asset match, and Pisces together, they are effectively joining forces to transform your business. It's such a great honor for me to be able to thank you for being part of this journey, the Exponential Blueprint. There are 22,000 founders, investors, and C-suite executive who have joined us since January, and it would be a pleasure to hear your comments, for you to write your comments below as well. Ask us any question. We'll answer to all questions, by the way. No question will ever remain unanswered, either on this YouTube channel or on our newsletter, which is a free newsletter, of course. Yeah. And with this particular video, I would like to invite you. You will find to the bottom right, the button to subscribe to this channel. There are already 43,000 people who've done so since March, which is phenomenal. And to the left, to be able to see the next part, which is part 5. So you can click on part 5 as you see this video right now. Thank you very much, James, for joining me today.
Thank you for inviting me, Matteo. Exciting times.
Exciting times indeed, and let's move forward. Thank you, and see you to the next video. Thank you very much.